The current dynamics in the cryptocurrency market, particularly within the realm of Bitcoin, exhibit a fascinating interplay between what is commonly referred to as smart money and dumb money. Michael Saylor, the outspoken advocate for Bitcoin, presents a compelling argument for the positive impact of institutional involvement, specifically through the lens of Bitcoin ETFs. His perspective not only underscores the transformative potential of these financial instruments, but also sheds light on the evolving landscape of decentralized finance. Saylor's distinction between smart money and dumb money is rooted in the strategic choices of investors. Smart money, as per Saylor, is channeling its resources into Bitcoin, recognizing it not merely as a speculative asset, but as a decentralized crypto commodity network. On the flip side, what he terms as dumb money appears to be flowing into more traditional assets like gold, real estate, equity, or bonds. This categorization emphasizes a paradigm shift where institutional players are acknowledging the unique qualities of Bitcoin and positioning themselves accordingly. One of the central tenets of Saylor's argument is that the entry of new participants, even institutional giants like BlackRock, serves to further decentralize the Bitcoin network. The logic behind this assertion is grounded in the idea that a larger and more diverse pool of participants reduces the likelihood of network corruption. In essence, the power and influence become diffused, creating a more robust and resilient decentralized system. Moreover, Saylor sees powerful entities and companies across different countries as potential guardians of the Bitcoin network. He posits that their interest in defending Bitcoin against external threats, including potential attacks, fortifies the overall integrity of the network. This aligns with the notion that as Bitcoin becomes a global financial instrument, it attracts not just individual investors, but also the attention of influential players with a vested interest in its stability. Contrary to the fear that large players like BlackRock might pose a threat to Bitcoin, Saylor dismisses this notion. Instead, he argues that these entities contribute to the network's strength by bringing in substantial resources and a plethora of participants. This perspective challenges the traditional narrative of institutional involvement being a potential risk to the ethos of decentralization, asserting that it can, in fact, reinforce the network. Saylor also addresses the potential influence of Middle Eastern countries acquiring significant amounts of Bitcoin. He contends that even if a country in the Middle East were to make a substantial investment, it wouldn't necessarily translate into control. Instead, such an action would contribute to the network's strength, creating a counterbalance to any potential adverse positions and fostering a more globally distributed ownership. A key aspect of Saylor's argument lies in the conservatism exhibited by larger actors with significant investments in Bitcoin. These institutional players tend to resist enthusiastic proposals for radical changes to the network, prioritizing stability over rapid innovation. This cautious approach, according to Saylor, serves as a stabilizing force, preventing the kind of volatility that might arise from hasty decisions. The advent of Bitcoin ETFs, particularly those launched by financial giants like BlackRock, is hailed by Saylor as a positive catalyst for the cryptocurrency market. He points out that these ETFs have outperformed other traditional counterparts, amassing over $52 billion in combined assets under management, AUM, within the first 30 days of their launch. This success is indicative of the growing institutional interest in Bitcoin, further fueled by the scarcity of the asset. Institutional capital flowing into Bitcoin is identified as a significant driver of the current price surge. Saylor attributes the increasing interest and investment in Bitcoin to its inherent scarcity. As traditional markets face uncertainties, the finite supply of Bitcoin becomes an attractive proposition, driving institutional capital toward the digital asset. Bitcoin ETFs, in Saylor's view, provide much-needed regulatory clarity for Bitcoin as an institutional-grade crypto asset. They serve as an on-ramp for institutional money, seamlessly connecting a vast pool of capital to the cryptocurrency. This regulatory clarity not only enhances the legitimacy of Bitcoin as a financial instrument, but also streamlines its integration into the broader financial ecosystem. Furthermore, the introduction of Bitcoin ETFs opens up new avenues for mainstream investors. The instant access to information and functionality provided by these financial instruments makes Bitcoin more widely recognized and accessible through traditional trading platforms. This increased awareness, coupled with the legitimacy afforded by institutional involvement, contributes to the gradual acceptance of Bitcoin as a legitimate asset class. Beyond the realm of awareness, Bitcoin ETFs also play a crucial role in establishing a global protocol for trading volatility and issuing credit. These financial instruments enable various operations, including obtaining loans against Bitcoin holdings. The emergence of such protocols signifies a maturation of the cryptocurrency market, providing additional utility and functionality to Bitcoin beyond its role as a store of value. The success of Bitcoin ETFs generates media coverage and Wall Street awareness, according to Saylor. This increased visibility is deemed crucial for the broader understanding and acceptance of Bitcoin as a legitimate and viable asset class. As institutional players, including financial giants, actively participate in the cryptocurrency market, the narrative surrounding Bitcoin shifts from a speculative venture to a recognized and respected investment avenue. Saylor goes on to suggest that the launch of ETFs has played a pivotal role in the recent upward trajectory of Bitcoin's price. The introduction of these financial instruments has catalyzed institutional interest, acting as a driving force behind the surge that has propelled Bitcoin back toward its all-time high. This reinforces the idea that institutional involvement, particularly through well-regulated channels like ETFs, can significantly impact the valuation and perception of Bitcoin in the broader financial landscape. With the introduction of Bitcoin ETFs, Bitcoin has undergone a transformation from a niche digital asset to an institutional-grade investment easily accessible through traditional financial tools. This accessibility opens up new possibilities, including leveraging Bitcoin for mortgages or margin loans. The evolving role of Bitcoin as a financial instrument signals a paradigm shift, where digital assets seamlessly integrate into established financial systems. In conclusion, Michael Saylor's perspective on the interplay between institutional involvement, Bitcoin ETFs, and the broader cryptocurrency market paints a picture of evolving dynamics. The delineation between smart money and dumb money reflects a changing mindset among institutional players, acknowledging the unique qualities of Bitcoin. The success of Bitcoin ETFs is seen not just as a financial triumph, but as a catalyst for broader awareness, acceptance, and integration of Bitcoin into mainstream financial systems. As we navigate this ever-evolving landscape, it is essential for investors and enthusiasts alike to conduct thorough research and consult professionals for informed financial decisions. The information provided here is for general purposes, and the rapidly changing nature of the cryptocurrency market necessitates a proactive and well-informed approach to navigate its complexities. Please go ahead by liking, subscribing, and sharing with friends to support our content. The information is for general purposes. Viewers should conduct research and consult professionals for financial decisions.